Hey everyone, and welcome back. Today we're going to be looking at something super interesting, some alternative ways to get into the Australian real estate market,
Oh, yeah.
which is perfect if you're, feeling like maybe traditional home ownership is just a little bit out of reach right now.
Yeah. Especially in Australia.
Yeah, exactly.
The market's pretty crazy right now.
So this deep dive is inspired by the Aussie Real Estate Riches podcast,
Oh, cool.
and specifically an episode they did on fractional and co-investing.
Okay.
So let's unlock some of these maybe creative paths to property.
Yeah, it's interesting how these methods are opening doors for a wider range of investors.
Right.
Like we're seeing a real shift in how people are approaching real estate.
Okay, so first up, fractional investment.
Yes.
I've heard this described as like buying shares in a company, but for property.
Right.
Can you break that down a little further for us?
Absolutely. So instead of buying a whole apartment or a whole unit,
Mm-hmm.
imagine owning a tiny slice of an apartment building. So you're essentially pooling your resources with other investors to purchase a property.
Right.
And then your returns are tied to your ownership percentage.
So you're not just betting on like one property in one location.
Right.
That sounds a bit like diversifying your stock portfolio.
Exactly. You're spot on.
Okay.
Diversification is a major advantage here. Instead of putting all your eggs in one basket,
Right.
you can spread your investment across different property types, locations, and even risk profiles, which can help mitigate losses if one sector of the market takes a dip.
Yeah, that makes a lot of sense. And I'm guessing this approach requires a smaller upfront investment
Yes, much smaller.
than buying a whole property.
Exactly. You can often get started with just a few $100s on some platforms,
Wow.
which makes real estate investing accessible to a much wider audience,
Right.
particularly those who might be a bit intimidated by the traditionally high barrier to entry.
Absolutely. That's a game changer,
Yeah,
especially for younger investors or those with, limited capital.
yeah, for sure.
But with shared ownership, I imagine there's less individual control over the property itself.
That is the trade-off.
Okay.
While you benefit from property appreciation and potential rental income,
Mm-hmm.
you typically have very limited say in the day-to-day management.
Right.
Decisions are often made by the platform or majority shareholders.
So if I'm someone who likes to be like very hands-on with my investments, this might not be the ideal route.
It really depends on your investment style and your comfort level.
Sure.
Some investors prefer a passive approach.
Right.
They're happy to leave the management to experts while they just reap the financial rewards.
Yeah.
Others crave more control, more decision-making power.
All right. So let's say fractional investing isn't quite the right fit.
Okay.
What about this idea of co-investing, where you're teaming up with family or friends
Yeah.
to purchase a property together?
This is where things get interesting.
Go.
Co-investing allows you to really leverage that collective purchasing power, potentially affording a property that would just be completely out of reach individually.
So you're essentially combining forces to achieve a shared goal.
Exactly.
Like that classic, two heads are better than one approach.
Yeah, exactly. You can pool your resources, you share the responsibilities of ownership,
Right.
and you can really benefit from each other's strengths.
Okay.
However, it's critical to establish a really solid legal framework.
Oh, yeah. I can see how things could get messy without clear guidelines.
Imagine purchasing a property with a friend, but you haven't clearly defined each person's financial contribution
Right.
or ownership percentage.
Yeah.
What happens if one person wants to sell their share?
Yeah.
Or if disagreements arise regarding renovations or rental decisions?
Yikes. That sounds like a recipe for conflict.
Yeah,
So a well-drafted legal agreement is crucial to protect everyone involved.
absolutely. This agreement should outline each party's ownership stake,
Okay.
their financial obligations, their responsibilities for maintenance and management,
Mm-hmm.
and a clean exit strategy.
So you're not just relying on like trust and goodwill.
No,
You're putting everything in writing to avoid future headaches.
exactly. It's all about setting realistic expectations and boundaries from the outset.
That sounds like a smart move.
And of course, seeking legal advice tailored to your specific situation is always highly recommended.
This is all great information. We've covered fractional investing
Yeah.
and the importance of a solid legal framework for co-investing.
Mm-hmm.
But what about the broader advantages and disadvantages of shared ownership in general?
So shared ownership, whether through platforms or with friends and family, offers a unique set of pros and cons.
Okay.
One major advantage is that lower barrier to entry.
Right.
You can get your foot in the door of the property market without needing a massive down payment.
Right.
This is particularly beneficial in Australia, where property prices can be quite steep.
Yeah, that's definitely appealing, especially for first-time buyers
Yeah,
or those feeling overwhelmed by the traditional homeownership route.
for sure.
But what are the potential downsides?
Well, the main trade-off is control.
Okay.
With shared ownership, you inherently relinquish a certain degree of autonomy. Decisions regarding the property need to be made collectively,
Makes sense.
which requires really clear communication and a willingness to compromise.
Right, you can't just repaint the kitchen or install a new fence without consulting your fellow owners?
Precisely. And while shared ownership offers the potential for property appreciation and rental income,
Right.
your returns will be proportional to your ownership share.
Okay.
You won't reap the full financial rewards as you would with full ownership.
So it's all about weighing the potential benefits against the limitations.
Yeah.
Shared ownership might offer a more accessible entry point,
Yeah.
but it comes with the understanding that you're sharing control
Right.
and potentially smaller profits compared to full ownership.
Exactly. And this is where understanding your personal investment goals,
Mm,
your risk tolerance, and desired level of control becomes crucial.
right.
There's no one-size-fits-all approach.
This is all super insightful. Now, I'm really curious to delve deeper into the world of these fractional investment platforms. Can you walk us through how they actually work?
Absolutely. Let's break down the mechanics of these platforms
Okay.
and explore some key considerations before taking the plunge.
Okay, let's dive in. This is where things start to get really fascinating.
Yeah, for sure. So think of these platforms as like carefully curated marketplaces.
All right.
They connect property owners who are looking for investors with individuals like yourself
Right.
who want to invest in real estate,
Mm-hmm.
but without all of those traditional hurdles.
So it's a bit like a matchmaker
Yes,
for investors and properties.
that's a great way to put it.
Okay.
These platforms do a lot of the legwork for you.
Hmm.
They thoroughly vet the properties,
Okay.
they conduct due diligence, and then they divide the ownership into these smaller shares.
So they're taking on like the research and selection process.
Exactly,
Okay.
making it a lot more manageable for individual investors.
Mhm. What kinds of properties are we talking about here?
You'll find a wide range from residential apartments and townhouses
Okay.
to commercial properties and even developments in up-and-coming areas.
Wow.
Each platform has its own kind of niche and focus.
Okay.
So it's really important to explore a few different ones
Right.
to find one that aligns with your investment goals.
That makes sense. You wouldn't invest in just any stock without doing your research first.
Exactly.
Same goes for fractional property investments.
Exactly. And once you've invested, these platforms often handle the property management,
Okay.
tenant screening, and even the distribution of rental income amongst the shareholders.
Wow, that sounds almost too good to be true.
Yeah, it can be pretty hands-off.
You get a piece of the real estate pie without the hassle of being a landlord.
Right.
But surely there are some downsides to consider.
Well, like any investment, there are inherent risks.
Of course.
While diversification can help mitigate losses,
Hmm.
you're still exposed to market fluctuations. If property values decline, so does the value of your shares.
That's true for any real estate investment, though, right?
Exactly.
You're riding the waves of the market, whether you own a whole property or a fraction of one.
Exactly. And remember that with fractional ownership, your control is limited.
Okay,
You're trusting the platform
right.
and potentially majority shareholders
Mhm.
to make decisions about that property.
Okay, so if I had like a brilliant idea
Yeah.
to say, install solar panels on the roof
Uh-huh.
to increase the property's value and appeal to eco-conscious tenants,
Okay.
I couldn't just make that call unilaterally.
Probably not. Major decisions typically require agreement
Okay.
from a majority of the shareholders, and this is outlined in the platform's operating agreement.
Gotcha.
It's really important to familiarize yourself with those terms
Okay.
before investing,
So it's less hands-on than owning an entire property yourself,
for sure.
but you're still participating in the real estate market,
Yes.
potentially earning passive income.
Right.
And with a lower initial investment.
Exactly.
Okay, now another key consideration is liquidity.
Yeah,
Traditionally, real estate is considered a less liquid asset
it is.
than, say, stocks.
Yeah,
Selling a property can take time and involve various costs.
exactly. It's not as simple as clicking a button and selling your shares on a stock trading app.
Right.
However, some fractional investment platforms are addressing this issue
Okay.
by providing internal marketplaces
Oh, interesting.
where investors can buy and sell shares amongst themselves.
So it's like having a mini stock exchange
Yes.
within the platform itself.
Yes, this feature aims to improve that liquidity,
Okay.
potentially enabling investors to exit their investment more quickly if needed.
Okay.
Of course, the ease and speed of selling will depend on factors
Right.
like market demand and the platform's specific rules.
Okay, so we've covered how these platforms work,
Yeah.
the potential upsides and downsides, and this element of liquidity.
Yeah.
How do I know if fractional investing is a good fit for me personally?
That's a great question.
What kind of investor would thrive in this space?
So fractional investing is particularly well suited for individuals
Okay.
who are comfortable with a moderate level of risk,
Okay.
appreciate the benefits of diversification,
hmm
and prefer a more passive approach to real estate.
So if I'm someone who loves the idea of owning a piece of property,
Yeah,
but doesn't want the headaches of being a landlord,
right.
this could be a viable option.
It could be a great way to gain exposure to different sectors of the real estate market
Okay.
without needing a large sum of capital.
This is all incredibly helpful.
Good.
But before anyone rushes off to invest,
Yeah.
what's the most important piece of advice you can offer?
Do your research.
Okay.
Don't just jump into the first platform you come across.
Right.
Each platform has its own unique features,
hmm
fees, property selection criteria,
Okay.
and target market.
So just like you wouldn't buy a car without test driving it first,
Yeah.
you shouldn't invest in a fractional ownership platform
No.
without thoroughly understanding how it works and whether it aligns with your goals.
Couldn't have said it better myself.
Great. Now, shall we shift gears
Yes?
and explore this dynamic world of co-investing with family and friends?
Let's do it.
I'm eager to uncover the complexities and potential rewards of joining forces with loved ones in the real estate arena.
It's a whole other ball game.
Okay, co-investing with family or friends.
Yeah,
It sounds like a fantastic way to pool resources
it can be.
and maybe even get into a property ladder rung that would be out of reach solo.
Yeah, definitely.
But I'm guessing there's more to it than just high fives and good intentions.
Absolutely, you're right.
Right.
While the idea of co-investing is simple, the reality requires careful thought, open communication, and a very solid legal foundation.
So where do we even begin?
Okay.
What are like the first steps to consider if I'm thinking about co-investing with someone close to me?
The most important step is defining those shared goals and expectations. Have a really candid conversation with your potential partners about your individual investment objectives.
Okay.
What are your risk tolerances?
Right.
What is your long-term vision for this property?
Right. Because what I might consider a charming fixer-upper could be someone else's never-ending renovation nightmare.
Exactly.
And maybe one of us wants to rent the property out long-term,
Right.
while the other sees it as a potential flip down the line.
Exactly. Alignment on the type of property, the location, your budget,
Right.
and even your investment time frame is crucial
Okay.
from the outset.
Okay, so we're on the same page about what we're looking for.
Yeah.
What's next? Can we start browsing real estate listings yet?
Hold your horses.
Okay.
Before you fall in love with a charming balcony or a spacious backyard,
Right.
it's crucial to establish a really clear legal structure
Okay.
for your co-investment.
Right.
This typically involves creating a formal partnership agreement
Okay.
or a joint venture agreement.
So we're talking lawyers, contracts, the whole shebang.
Yeah, it might feel overly formal,
Right.
but trust me, it's an essential step.
Okay.
This legal document is the bedrock
Okay.
of your co-investment.
Mm-hmm.
It outlines each party's ownership percentage, financial contributions, and responsibilities.
So it's like a prenuptial agreement,
That's a great analogy.
but for real estate partners.
Yes, protects everyone if things don't go as planned.
Right.
The agreement should also address what happens if someone wants to exit the investment,
Okay.
how profits and losses are distributed, and even the process for resolving disputes.
Makes sense. You don't want to leave any room for assumptions or ambiguity.
No,
That could lead to conflict down the line.
exactly.
But let's say we've got our goals aligned, our legal agreement in place,
Yeah.
and we found like the perfect property.
Okay.
Are there any other potential pitfalls we should be aware of?
One common challenge is navigating differences in communication styles
Okay.
and decision-making approaches.
Oh, I can see how that could get tricky. What if one person is very analytical and data-driven,
Right.
while the other is more intuitive and goes with their gut?
Yeah,
Those approaches could clash when it comes to making decisions about the property.
absolutely. That's the kind of dynamic that can lead to misunderstandings and frustration.
Right.
It's really important to establish clear communication protocols
Okay.
and a decision-making framework from the start.
So lots of open dialogue, active listening,
Yes,
a healthy dose of compromise.
exactly. Co-investing successfully relies on a foundation of trust, mutual respect,
Right.
and a willingness to navigate disagreements constructively.
This has been incredibly insightful.
Good.
I'm starting to see that co-investing can be a powerful strategy,
It can be.
but it's definitely not something to enter into lightly.
No,
It takes careful planning and a truly solid partnership.
you've hit the nail on the head.
Okay.
Now, zooming out a bit,
Okay.
these alternative paths to property ownership,
Mm-hmm.
fractional investing, and co-investing, they represent a real shift in the real estate landscape.
What do you mean?
They're making real estate investment more accessible for a much broader range of people.
Right.
This could reshape market dynamics,
Okay.
empowering more individuals to build wealth through property, even if they can't afford to go it alone.
That's a fascinating point as these approaches gain traction.
Yeah.
Could we see a future where traditional home ownership becomes less dominant?
It's possible,
Okay.
with more people opting for these shared ownership models. It's certainly a possibility as technology evolves and these platforms mature.
Right.
We might witness a fundamental shift
Okay.
in how people approach real estate.
Interesting.
It's a dynamic space to watch, and the potential implications
Yeah.
for both investors and the market as a whole are quite significant.
That's an exciting thought.
Ah,
Well, this deep dive has been an incredible exploration
it has.
of alternative property investment strategies.
Yeah.
We've covered fractional investing,
Mm-hmm.
the intricacies of co-investing,
Right.
and even pondered the future of the real estate market. What a journey.
It's been a pleasure sharing these insights with you.
Thank you.
I hope you feel equipped to explore these options further and make informed decisions that align with your financial goals.
Absolutely. And for our listeners, I encourage you to keep an open mind about these innovative approaches.
Yeah.
Perhaps fractional investing is your ticket to a slice of that dream vacation property.
Yeah.
Or maybe a co-investment with trusted friends or family could be the key to unlocking your real estate aspirations.
Oh, sure.
Great.
Remember, there's no one-size-fits-all path to property ownership anymore.
Right.
With a bit of creativity and a willingness to embrace new possibilities, you can chart your own course to building wealth through real estate.
Beautifully said. And on that note, we'll wrap up this deep dive. Until next time, stay curious and keep those investment strategies evolving.